What is a lot? This is what we will learn today. A lot is a standard unit of currency. Think of it like a tray of eggs, where one tray represents a fixed number, like 30 eggs. In the same way, one lot represents a fixed amount in trading. In Forex, one lot equals 100,000 units of currency. This system brings simplicity, especially when executing trades, because instead of mentioning large amounts of money, traders just state the lot size and everyone understands the value behind it. Banks needed this kind of standardization so that trading would not involve random amounts like $1,847, $14,447, or $51,991. So they introduced a uniform system where one lot equals 100,000 units, and this became the institutional trading standard. Originally, only this full lot existed, meaning participation was limited to those with large capital, mainly banks and institutions. Later on, retail forex brokers saw an opportunity in the 1990s to early 2000s and introduced smaller lot sizes to allow more people to participate. These included mini lots, which are 10,000 units, micro lots, which are 1,000 units, and nano lots, which are 100 units. This was a major milestone because it allowed individuals like you and me to enter the market, something that would have been impossible if only full lots were used. Now, the way these categories are derived is based on powers of 10. If one lot represents 100,000 units, then dividing both sides by 10 gives you 0.1 lots, which equals 10,000 units, that's a mini lot. Dividing again by 10 gives 0.01 lots, which equals 1,000 units, that's a micro lot. This continues further for nano lots. The reason traders focus on the fractional side, like 0.1 or 0.01, is because that is the execution side. When placing trades, you simply specify the lot size, and the corresponding monetary value is automatically understood. These lot categories were introduced over time to increase participation and improve liquidity in CFD trading. First came mini lots, but the volume was still low. Then micro lots were introduced, which brought even more traders into the market. Remember, in CFD trading, this is not the real market. You are not exchanging actual assets. Instead, if you take one side of a trade, someone else must take the opposite side for the system to work. For example, if you sell euro to US dollar, someone else must take a buy position. If the market moves in your favor, you make a profit, and that money comes from the other side of the trade. If the market moves against you, you incur a loss, and your money goes to the other party. This opposite side can be another trader, the broker, or large financial institutions known as liquidity providers. All these transactions are managed internally by the broker, which is why choosing the right broker is very important. Back in the days of physical trading floors, traders would simply shout their orders using these standardized units. For example, saying buy 2 lots meant a $200,000 position. Saying 4 minis meant 0.4 lots, which equals $40,000. And saying 7 micro meant $7,000, or 0.07 lots. This system made communication fast and efficient, and it is still used today in digital form. Now we understand what lots are and their categories, and how they are used to execute trades. As we continue, everything will become even clearer. In the next lesson, we will learn about pips as a way of measuring distance in the market. Stay tuned, and don't forget to like and subscribe.